Your history, your past, dictates your habits, and too often people are not addressing their trauma. And so when you understand what a healthy portfolio looks like, a lot of people become uncomfortable because you're being asked to heal. Welcome to How to Retire on Time, a show that answers your retirement questions. We're here to move past that oversimplified advice and get into the nitty-gritty. As always, text your questions to 913-363-1234. Again, 913-363-1234. And remember, this show is just a show. It's not financial advice, so make sure you do your research. David, what do we got today?
Hey, Mike, I don't want any risk and currently have all my money in a money market. If I gave it to an advisor, could they grow it better without any risk?
This is a very perplexing question, and here's why. What is risk? Let me ask you, David, what is risk?
Yeah, I guess
It's not existential.
I guess that when you're talking about risk, there's some sort of danger, right?
Yeah.
Like, oh, if I'm riding a bike, I have risk of falling over and hitting my head, so I put on a helmet, or fill in the blank.
In finance, it'd be loss of money.
Yes, yeah.
There's a pain or something negative that can happen, a negative consequence.
Okay, yeah, that sounds well defined.
So risk in the money, or if you're afraid of risk and you put your money in the market, you're scared of market risk. And then you're either not scared of or ignorant of inflation risk.
Yeah.
So you have to understand there is no such thing as a perfect investment product or strategy. There is no such thing as a riskless retirement. You need to accept that in life there's all going to be risk. There's going to be something that you have to address. There's going to be demons ahead of you that you'll need to face in order to create a healthy plan. So let's take our example here. He's got all of his assets like a money market or some
Everything's in a money market.
Okay.
Yeah, that's according to this question.
So this question brings me back to an example. So someone I know years and years, like over a decade ago, said, hey, I want low risk. I don't want any risk. Tells the advisor, I don't want any risk. What do you have for me? And this advisor, based on if you look at the details, his job is to put you in some sort of fund. So what does he do? He does the best that he can. He's got to get paid, but he does the best that he can. And he puts this person into very low risk bond funds. But when interest rates go up, bond funds lose money.
And how is that?
Right.
If we just like really quick sidebar.
Yeah. So if interest rates go up, right, new debt issuance, so like new bonds are paying a higher coupon rate than your old bonds.
Oh, right.
So think of it this way. This is my chicken analogy. If you bought a chicken for $1,000 and gave you 3 eggs a week, okay, you know exactly what you're expecting. Let's say foxes can't get to it. It's safe, it's secure, whatever. And then next week they're selling chickens for $1,000. They're going to give you 5 eggs every single week. Which chicken do you want more? Well, if it's the same price for the chicken, but one gives you 2 eggs more every single week, you're going to naturally want a higher yield. So when interest rates go up, basically it's new chickens laying more eggs. So all the people that bought a chicken that's laying 3 eggs, they're going to have to sell it at a discount. They have to somehow sell it at a lower amount of money or on sale, basically, to compensate for the lost eggs that they would have gotten if they just bought a new chicken.
So that's the risk in investing in bond funds.
In bond funds.
Okay.
Yeah. They're actively trading bonds. So because of that, if interest rates go up, they're selling old chickens, trying to buy new chickens, and that creates a loss. Okay. So this person wanted no risk. They went into a low risk. It went down. They panicked. They didn't like it. They didn't understand it. They didn't have experience in the market. It was not explained well to them. And so then they went back and just stuck everything in the high yield savings account. And that's all they've done ever since.
Yeah, and what's the risk in that? Tell us.
Inflation risk. If your funds are not in a qualified account, so that's a retirement account like an IRA or a Roth, your growth is it's taxed as income tax. So that's line 2B of the tax code, or not tax code, but your 1040. 2B is taxable interest. So let's say you got 4% interest every year. What's your effective tax rate? That's kind of what you're paying on that interest rate. Kind of. I'm oversimplifying a few things, but the crux of this question there's two problems that need to be addressed. Let's do the first one, the expectation of an advisor. Okay. When you have an advisor and you ask them, hey, can you get more money from a high yield savings account? The advisor, who is sales focused, their job is to acquire more assets, will probably say, yeah, absolutely, we could probably do that. But you can't guarantee results. And I'm not saying any advisor would say we can guarantee results, because no one really does that. And if they do that, let someone know that's illegal to promise returns, even to suggest or infer that, yeah, we're going to get around here. You can say, historically, this is what we have done, but we can't promise you future performance. We don't know what the future markets has. Our job is to be an advisor and manage it to the best of our abilities to give you the best return based on your risk suitability. That is the appropriate. That's like saying, hey, I want medication with only benefits and no side effects. Well, that doesn't exist, right? So there's always side effects. There's always risks associated with it. So if you ask an advisor saying, hey, I've got it in a high yield savings account or a low risk bond fund, I want more money, but I want no risk, the advisor is absolutely compromised. And the reason is twofold. One is if the advisor puts it in the market, there's risk. And the person has said, I don't want any risk. That's compromised. The whole situation's now is gone off the rails, because you can't put it in the stock market, in ETFs, in bond funds, or any of these things and still do what the client asked. The advisor is compromised. And the person might say, well, can you give me a more realistic, just paint the picture. In 10 years, what would it be like? That's an oversimplification of their emotional state, because it's not in 10 years. People aren't actually emotionally resolved. They're emotional. People are emotional. So in the first year, the markets tank. Well, we had the conversation in 10 years, it should be up. That could be a true statement. It probably is a true statement. But along the journey, they might get pissed. Maybe it wasn't totally suitable for them. So the advisor is absolutely compromised, because if you do try to grow it, there's risk. Now, you might say, well, Mike, there's other things you could grow without risk. Yes. If you want a CD, maybe you could put it into a CD, or let's say what another example? You could do CD, you could do a treasury, any bond instrument, depending on the credit rating of it. So like a corporate bond, if you want. You could do a fixed annuity. A lot of people don't realize that a fixed annuity is a CD from an insurance company. As long as you're 60 years old or older, it's just a CD from an insurance company. You don't need to turn on income, or there's no fees. It's just put it in here for a certain amount of years and it grows at that fixed rate. That's it. Really boring. Doesn't pay much of a commission, so I don't think they're talked about a lot either. But if you put your money into a fixed investment or product as such, why would you pay an advisor fees? Therein lies the complicated bit. If you put something into a indexed product, so a buffered ETF, so it has buffered protection, so whether it's some of the downsides protected or most or all or certain thresholds protected, you've got limited upside. There needs to be a realistic expectation that some years you'll make some money, some years you might not. It just depends on the market. But what are you paying the advisor for at that point? Because you just let it sit there. So the idea of asking an advisor to make you more money with no risk, all the things that you could offer that have no risk, do not rationalize any sort of ongoing fee. It would be a one-time service. Here's some recommendations. Here's what you could do. Now there's really nothing I can do at this point.
Because it's fixed. The advisor isn't managing anything. He's not, or she is not moving
The
money
second
around.
you actively trade it, you're creating risk.
Yeah, right. So it wouldn't be suitable for someone who is risk averse.
Now, if you pose this question to an insurance agent, or maybe they're duly licensed, so they have a securities license and an insurance license, it's got annuity sales all over it, which may or may not be right for this person. I don't want to suggest anything. By definition, an annuity is transferring longevity risk to an insurance company. And maybe this person's going, hey, I just want stable income. Great. Maybe the annuity is right for you as long as you're okay taking inflation risk and tax risk. Because if taxes go up, your income goes down, right? It's all about net income. But if they're already keeping their money in a high yield savings account and that's it, maybe they're already okay with those risks, or maybe they didn't even realize it. Now, is that extensive of a conversation going to happen? Probably not. That's the sad truth. But you need to be aware of that. In addition to that, you might be like, well, a fixed index annuity, you've got more upside potential. no downside risk, and you can pull out 10% whenever you want. That is true. Make sure there's liquidity risk. That you got to address liquidity risk. So what if you need more than 10%? What are the other needs? So when someone asks a question like that, it sets up the advisor to either give you a product pitch without doing a full suitability review. I know we're supposed to. I just understand that it's like we want to live in a utopic society, but the reality is I don't think there's proper vetting of these products before they're placed, because the people come into my office and they complain about, I didn't know X, Y, Z, or I didn't realize this was a risk. I didn't realize it could go this way. So because of my anecdotal experience of having to clean up other people's messes, I'm not so optimistic about it. But then why would you charge an advisor fees, or why would you pay advisor fees for the ongoing service? So it's that's on the advisor side. Now, if this person ends up in an annuity and the proper conversations there, maybe that's appropriate for them. Maybe they split some funds. Maybe they do a hybrid. I don't know. There's many ways that it could be done, but ongoing management fees in that situation, I don't see it making sense.
Yeah, so did we answer the question then?
Nope, we haven't.
Okay.
Now let's get to the real stuff here.
Okay,
This is where it's important. And I hope everyone listening, whether it's on YouTube, podcast, this is the part where we're 10 minutes or so into the show. This is where you bookmark it and you listen to this over and over. And for all the people listening to via radio, because we broadcast this on radio, which is a lot of fun, this is where you then go and subscribe to the show, How to Retire on Time, and you listen to this over and over again. This is your unofficial therapy for the day. Okay? Not a therapist. But almost without exception, when someone asks me this question, I say, what happened historically that caused you to fear the market so much? And almost unanimously, it says, when I started investing, the markets kept going down, and I've avoided it ever since.
Right. They have that sort of past trauma of they just have those memories of, I just watched my balance sort of go down or stay flat.
Unresolved trauma.
Yes.
And if you do not resolve your trauma, whether it's related to investments, whether it's related to relationships, whether it's related to self-doubt, maybe someone bullied you in your childhood, and these are demons, it's traumatic experiences that weigh on you for the rest of your life unless they're addressed. Here's my framework. It's rather simple. Your history, your past experiences, and how you've perceived them shape your habits. Your habits are behavioral systems that basically predict what you're going to do in any given moment. So if someone aggressively speaks to you, your habit will be either to shut down or to try and speak louder. That is a habit. It's a behavioral reaction to the situation. Your habits create your habitat, your state of being. Those who are happy, those who have amassed extra wealth, those who have healthy relationships, they have healthy habits that have created a very happy habitat, just a general lifestyle. Those who have had a history, trauma that was unresolved, created habits that has caused them to infinitely live a lower quality of life comparative to had they had resolved them. And I don't want to there are some horrible things that happen. I am not minimizing trauma. I'm not minimizing that some people have had some very messed up experiences in their life. And I can't explain why it happens. All I can say is things happen, and it is our individual responsibility to address them. Why am I saying this? Because everyone that comes to my office has a bias. And every time that bias is traced back to a historical moment or series of moments that has either distorted their perception of something, where they've then compounded this idea, and then they're walking to my office not defining things as they are, but as they want them to be, and it's leading them to a riskier retirement than they realize. Your history, your past, dictates your habits, your ability to make decisions, your behavior, or your systems that then dictate your outcome. And too often, people are not addressing their trauma. They're not addressing their past. That's distorting their reality. And it's easier to say, I don't care, I just want this, as opposed to healing and becoming a better version of yourself. And so when you understand what a healthy portfolio looks like, what healthy conversations around your finances looks like, when you have that baseline, A lot of people become uncomfortable because you're being asked to heal. You're being asked to be a better version of yourself, and that means giving up some of your, let's say, biased addictions, the addiction to perceive things in a certain way. You ever met someone that's like, the world's always out to get me?
Sure. Yeah.
You ever met someone that's just, the world's my oyster and everything always works out?
Yeah.
Those are polar opposites.
Yeah.
And that juxtaposition, they're both so imbalanced that whether they realize it or not, it's hurting them.
And so have you seen in your career someone who maybe they take your advice, they get the healthy portfolio, they have some discomfort at first, but have they sort of have you watched them work through it and get to the other side? Yeah.
Yeah.
How did their life get better?
They have now permission to live. So let's use an example. Some of my wealthiest clients and even some family members that have done well for themselves are so frugal. They're so uncomfortable spending money that they'll take the red Solo cup and they'll wash it. Okay? And we've got people at the office now laughing about this because they know even the family members that do this. Okay? But it's funny because there are many clients that we have that are so frugal, they don't want to waste anything. Now, they have multiple millions of dollars. They can't spend all their money. But they're so uncomfortable even going on a vacation because it might be a bad steward of their money. It's an unhealthy relationship with money. And so a lot of the times we have to work through then, how do you budget, not to prevent you from overspending, but to force you to spend and create meaning to your money. You don't need to spend it on yourself, but you need to spend it in some way. Maybe that's creating an endowment that in perpetuity is spending money for technical schools, college educations, professional trainings, whatever it is. Maybe it's saying, hey, here's $50,000 you're supposed to spend every year and you're being forced to spend it. What do you want to do? It's like, well, I don't really know. And then we explore those options. And maybe it's like, hey, there's a couple of families that are really in need. Let's do a few things here. Or maybe it's we're going to do a family vacation and create a memory that they'll remember forever.
Sure, yeah.
It's when people think budgets, sometimes a budget is restriction.
Right.
The other times it's forcing you to do something. Think about it this way. Many of us struggle eating healthy. I'll admit I have my bouts where I'm a bit gluttonous. And as we go into the holiday season right now,
yeah, haven't helped me. Goodness.
When you're trying to be healthy, there's really two options. One is you want to lean down, okay, so you want to shed the fat. And another one might be, and this includes the retirees, gaining muscle mass. So I think it's like mid-30s is when you start actually losing your muscle mass unless you deliberately try to grow your muscle mass. So you might be in your, 50s or 60s saying, gosh, I'm a little frail, more frail than I want to. I need to build muscle mass. You cannot have the same diet and accomplish both those goals. You either have a calorie deficit to shed the weight, or you have a calorie surplus to gain muscle mass.
And so we're transposing that onto like in a budget situation.
Just notice, there's a difference on the intake of calories. There's a difference on how you're spending money. But notice it's all based on principles. It's all based on precepts, frameworks. Yeah. What does it look like to have a healthy relationship with money? What does the conversation need to be? And then you need to add to that, can you define things as they are? If I show you a hammer, most people can define what a hammer is. A hammer is a device to put nails into walls or to pull nails out. I guess you could also do demo day with it, right?
Oh, yeah.
You could use it to destroy things,
yes.
But that's kind of it.
Right.
A hammer was not invented to hit your thumb. Yet some people might be, and I'm doing this a little bit, in a joking manner to just illustrate a point. Maybe you have a horrible time hitting nails and you keep hitting your thumbs. That's not what was intended to do. Define things as they are. And then you can have a healthier conversation of what do you actually want. At the end of it, we typically ask for a certain result, but we're unwilling for the conditions that we need to accept to get that result. We all want growth, protection, and liquidity. No investment offers it all. So how much should be in growth and protection? how much giving up liquidity, how much should be protection in liquid, like your emergency fund, and how much is growth in liquid but has risk. It's not protected. And then are you okay with those mini portfolios, knowing that some of it has certain detriments, knowing that some of it has certain timelines? And then you have to do these exercises. And I'm being a little long-winded today, but then you start doing exercises. And we have clients that actually come in, not for therapy, because we're not therapists, but for coaching, where they walk through and they reiterate and re-articulate their plan. And we start doing exercises to say, well, what if this were to happen? Because they're scared to death of the next market crash. And I say, okay, if the markets were to crash, here's your list of accounts. Now, where are you going to pull the portfolio from? Where are you going to pull your income?
We
What's
give them
liquidity?
a protocol
Yeah.
to follow, a playbook.
Yeah. And as they start to learn it, as they start to envision it, what they're doing is they're changing their behavior, their habits, so that when something happens, they're not going back to previous habits based on traumatic experiences. They've redefined, they've got new neurological pathways in their head. They know what to do in that moment, and they're comfortable with that. It takes work to do. But what that person asked is basically saying, hey, I want an unhealthy relationship with my advisor who's either going to take advantage of me or sell a product. And I also want a portfolio that is not healthy because I'm only concerned about one risk and I'm completely ignorant to all the other risks. Advisor, take advantage of my situation. And I don't know a single advisor in the country, and I've coached advisors all over the country. I've been on many panels speaking. I've been the keynote speaker of different events. I don't know a single advisor that would say what I just said in the country.
That's wild.
You have to push back and you have to understand what is health when it comes to your money. And if you don't push back, that's when people end up in crappy situations with illiquid assets that aren't serving their needs, when their lifestyle and legacy goals are not properly aligned with their plan and portfolio, when people are getting into tough spots. And sometimes you might not realize you're heading that direction until 10 or 30 years later, whatever that timeline is, and then you're kind of stuck. For everyone listening right now, whether it's on YouTube, podcasts, radio, whatever it is, please do the following. If you have an emotional resistance towards anything financially related, what if you could become neutral and define it as it is? That doesn't mean you need it. It means you can define the investment or product as is. What if, instead of you saying, well, this is what my work income is, I'm just going to make everything work in life. What if you deliberately designed your next phase of life, figured out how much that would cost, and then started putting your plan together? Then you started putting together your your strategies, so how to get more out of your money, and then you looked at the investments or products that would then fulfill your plan and your strategies. There's a certain sequence that has to be done for this to work, and too often it's in the first or second visit. Here's something that just helps you grow your money. You've made enough. Don't worry about it. You're fine. Now go live your life, whatever you want. We'll just figure it out along the way. That's a great way to live in chaos and uncertainty, which creates a lot of emotional distress, especially for someone that's had a traumatic experience, no matter how big or small it is when it comes to their money. We need to work through these things, and financial advisors need to do people a service in slowing down the conversation and having more deliberate conversations like this.